Before I open it up for comments, I just wanted to push you a bit on two questions. First, I mean, you mentioned at the start you weren't going to get into all the unorthodox matters, but you did have that chart about monetization of fiscal deficits. Let's say, perhaps unrealistically, but let's say that we were able to sustain an inflation rate of 3 or 4% in the advanced economies instead of 1.5% for this 7-year period without it getting out of control. I'm not saying that's legitimate, but just if you were able to do something like that, would that make a material difference, or is it not worth the risk? How do you see that kind of thing?
Yeah, we actually made the calculation, and I think you can find the result in this issue of the fiscal monitor. Not exactly the numbers that you mentioned. What we have computed is what would happen to the debt to GDP ratio if inflation were raised from 2% to 6% over a 5-year period. And a key assumption is, of course, what happens to nominal interest rates on the newly issued debt. We assume, perhaps conservative, but we assume that the real interest rate is not affected. So nominal interest rate on newly issued debt, after you announce this policy, will respond to higher inflation. In this case, you do get a break, but it's not huge. After 5 years, the debt to GDP ratio will be lower than in the baseline by something like, depending on the country, 7-8 percentage points of GDP. I think Italy has a higher number and Japan has a higher number. It will not make a huge difference in the following sense. The increase in the debt to GDP ratio in this country has been of the order of 30 to 40 percentage points. So moderate inflation at 6% would erode perhaps 1/4 of this, but no more than this for the first 5 years. And after 5 years, you don't get much more because nominal interest rates have already risen. And so to make a difference, because we have computed also this, to make a difference, you will need to bring inflation to 25 to 30% for 2 years. So you need a huge inflation shock. And in that case, you would erode about 30%, 35% of public debt. But again, who wants inflation at 30%?
Not even I. Second question, if I could. You focused quite sensibly and with beautiful visuals on the advanced economies. One thing which we hear a lot rhetorically, but I think also based in fact, is that a number of the so-called emerging markets have actually been more disciplined with their fiscal policies in recent years than the advanced economies. So when you were doing your 10 commandments, or when you're making these empirical assessments, do you think that there's anything we can get in terms of intellectual flow from some of your other member countries back to the advanced economies? Or is it just apples and oranges we don't need?
No, I mean, there are several, if the question is whether there are several lessons that the advanced economies can learn from emerging economies, there is one clear one, that in the 10 years before the 2007-2008 crisis, the emerging markets did use the good times to lower the debt to GDP ratio, which is not what happened in advanced economies. They managed to run policies that were much less pro-cyclical in the past. So many of these countries did use the good times to lower public debt, including countries that were benefiting from high revenues from natural resources. So that's a big difference. Of course, just as a small comment, there are, although emerging markets are now in a better position than advanced economies, there are some emerging markets they do have weak fiscal accounts. The Middle East is an area where you find high deficit and high debt countries. And you do find some large emerging economies like India and Brazil, where the public debt is still very high. India has a very high deficit also. And it's benefiting from a negative interest rate growth differential, which allows the country to run a very large primary deficit. It will not last forever, but for the moment, it is helping quite a lot.
Okay, very interesting. As usual, we're going to ask that our first couple questions or comments come from our guests, not from internal IIE people. People at the front, here, Doug, if you could identify yourself, then Randy. people towards the back, feel free to come up to the standing mic, please.
Doug Elmendorf from the Congressional Budget Office. Carlo, you sounded fairly sanguine about Europe. You noted the adjustments of the fiscal targets, but nonetheless, the continent is in recession. Some countries are in terrible downturns, and fiscal tightening is a factor. So how do you and Olivier apply your commandments under those circumstances? What does it mean to be neither a hawk nor a dove? What should those countries do for which any tightening of fiscal policy under current circumstances is part of what's pushing them into prolonged economic downturns?
Yeah, I mean, if I give an impression of being sanguine by Europe, I give the wrong body language, perhaps. No, the situation in Europe, as you know, is still very difficult. I think it's a positive fact that the European institutions are giving more time to European countries to achieve their targets. But the problem remains a big one, because some fiscal tightening will have to happen anyway. There are some good news in this respect, however, and some bad news too. The good news is that for at least two of the major European countries, Germany and Italy, the adjustment has already taken place. Italy is completing the phase of fiscal adjustment this year. They will not have to tighten further. So that's important. So the fiscal tightening that we project for the area in 2014 and 15 will not be as large as what we have observed in 2013, in 12 and 13. The bad news, however, is that the economies are not growing, and simply slowing down the pace of adjustment is not going to help growth very much. So it's clear that something else is needed in Europe. And I think that what remains critical are two things. One is more related to the long run, structural reform to improve productivity and competitiveness of the area, particularly of some countries. And the other thing that is extremely important is strengthening the banking system. One problem in Europe at the moment is that not only there is a fiscal tightening, but banks are not granting credit enough. And this requires, and this is a problem, and spreads for mortgages, for example, in Italy are of the order of 3–4%. And so it is really a problem for aggregate demand. What is needed there is to accelerate and complete the process of banking union, and in this context to recapitalize banks, not so much because banks need capital to be solvent, but they need capital to expand more rapidly credit. And we have used, and we have argued in the past, and we continue to argue that the money from the firewalls money should be used for this purpose, for direct injection of capital in the banks.
Before I turn to Randy and the gentleman at the back, just to turn about as fair play on Doug. I mean, in a sense, you were more than sanguine about the U.S. You said that the U.S. on net is probably overdoing it this year a bit. It's a view that I and several people in this room probably agree with. But just contrast that to the kind of rhetoric we've heard about the U.S. in the domestic U.S. debate about the imminent fiscal problems, the need for a long-term grand bargain and all this. I mean, does the tightening this year make any difference to that long-term worries that people have put out there for the U.S.?
But it's clear that if you tighten this year, this helps reducing the deficit or reducing the gap. I mean, the U.S. has managed to reduce its deficit from 13% of GDP. I'm talking about the general government and calendar years, but in this definition, the deficit was 13% of GDP in 2009. For this year, in the fiscal monitor, we were projecting 6.5, so halving, and probably with the most recent number, it will be even lower than 6.5. So it's clear that for those who are worried about the long-term trends in the fiscal accounts, this is a positive development. In my view, it is happening too fast. It helps achieving the long-term targets, but you could achieve those long-term targets through a more gradual fiscal adjustment.
Great, thank you. Randy Henning.
Randy Henning at American University. Thanks, Adam. There's a lot to respond to here, Carlo. Thank you very much. My question also related to Europe, and in particular, it relates to the fiscal compact and the fact that the rules under the fiscal compact have been defined in structural terms rather than nominal terms. And there are at least 3 international institutions that will be calculating the structural balance, right? The European Commission, the International Monetary Fund, and the OECD. So it's conceivable at some point in the future, a decision as to whether or not a country has abided by the rule under the fiscal compact hinges on exactly how that calculation is performed, and the 3 institutions might come up with different answers. So I'd like to ask you a little bit about how and whether you are coordinating and harmonizing kind of the methods by which these calculations are being made across these institutions. I don't necessarily think that harmonization is necessary, but at least it should be transparent how those calculations are being done.
Yeah, it's a very good question, and there are many things that one could say on this topic. First of all, it's true that the fiscal compact targets, the medium-term objectives are set in structural terms. The 3%, however, that triggers the excessive deficit procedure is still defined in nominal terms. But again, there has been more flexibility on revising when the 3% should be achieved. On the specific issue, the Europeans have their own methodology, which is agreed within Europe. So I think that formally they will continue to use their own methodology in computing the cyclically adjusted or structural balances. We, the OECD, we can provide our input in the methodology, and that's what we will continue to do. I don't think there will be necessarily a convergence on the methodology, but these are things that we regularly discuss with our counterparts in Europe. One more thing you need to keep in mind, that all European countries are setting up fiscal councils. And one of the goals of the fiscal council, of their fiscal council, will be precisely to compute whether fiscal policies are in line with the rules of the fiscal compact. And so things may become even more complicated than what they are now.
Joy. The gentleman at the back.
Thank you. Danny Xufengjiang with China's Xinhua News Agency. First, I want to ask, the U.S. fiscal situation is improving in recent months. The U.S. CBO projects the U.S. fiscal deficit for this current year would be $200 billion lower than its projection at the start of the year. So in your view, does this provide more room for more immediate term fiscal consolidation, or we shouldn't do so much sequestration in the immediate term to have a large impact on the economy? Secondly, in the medium term, what lessons should the U.S. draw from other countries to curb its healthcare spending, the main drivers of the deficit? Thank you.
Okay, on the first question, our position has been, even with our earlier projected deficit, we think that the U.S. could slow down the pace of fiscal adjustment. So, if anything, clearly achieving an even better deficit this year makes our position even stronger. But I don't think we have still to look at more closely at these new numbers, and we are doing it in the context of our annual consultation with the U.S. authorities. Whether these numbers change or not, the long-term picture we have to see, because I understand that these are temporary improvements this year. It's still uncertain whether they affect the long-term trend. But again, our point was that even with the earlier deficit projection, there was room to slow down the pace of fiscal adjustment this year. On the second question about the healthcare sector, as you know, healthcare spending has been rising over the last decades in the U.S. at a much faster pace. Public healthcare spending has been increased at a much faster pace than in most other advanced economies. So there is definitely something that needs to be learned. The key issue, I think, is the cost of medical services in the US, which is higher than in several other countries. There are studies showing, for example, that for the same medical procedure, the cost is 4 times higher in the US than in Germany. So there are things that need to be done to address this issue.
Yes, there are. The gentleman right there.
Felix Hüfner from the IIF. Just a follow-up question on the US. Were you surprised that the US economy was quite resilient so far in face of this huge fiscal contraction? Is that something that still comes with a lag? Or is it the case that the fiscal multipliers are actually lower than we think specifically on
No, I
consumption?
mean, our calculation is that without the fiscal tightening in terms of cyclically adjusted primary balance, which is a good proxy for the measures, is of the order of 1.75% of GDP. We now project a 2% growth of GDP for the US economy this year. If you assume a multiplier of 1, which is not particularly high, you get that in the absence of fiscal adjustment, you would have had a growth rate close to 4%, which is not particularly high, taking into account the fact that the economy is supposed to rebound from a pretty long and severe recession. So I think what is happening is more or less consistent with our calculation that the multiplier is at least 1, it could even be higher than 1.
Very good. Lee at the back.
Lee Price from the FDIC. I remember being in debates in 1989. The U.S. was very concerned about the deficit. We just passed Gramm-Rudman, and the question was what we were going to do about our thrifts and banks that were failing, and whether, in order to restabilize our financial system, it was worth putting over $100 billion into a fund to help resolve and deal with those. You had mentioned in the European situation today that they've got to strengthen their banking system. I look at the non-performing loans at European banks, and it's very distressing looking. So you say that Europeans should be tightening their fiscal situation, but strengthening their banks. How do you think they should think through the trade-off between their own fiscal situation, which I think may be somewhat analogous from our '89 situation, their fiscal situation, and their very weak banks that are crucial, much more crucial than our banks are to their economic credit system?
Yeah, first of all, as I said, the Europeans should proceed with fiscal adjustment at a moderate pace. So, and
but if the question comes, is it worth taking on more spending to help
I think
capitalize
that
their
the general answer is yes. The problem is that some countries don't have much fiscal room, and that's why we say you need to use the European money to recapitalize banks. There are some countries that cannot afford using their own money, and therefore the money that has been put together to support the euro area could be used for direct capital injection. So I think that would sort of, for those countries that do not have much fiscal room because their debt is already high, I think that would allow finding the proper way to address both problems, continue with some moderate fiscal adjustment and at the same time recapitalize banks.
Fiscal transfer and impose some cost of moral hazard on the banks that did the lending. Uri, and then at the back. The microphone's coming to you, Uri, just wait.
Yes, thank you very much. So, Carlo, one naive
That's
question.
Uri Dadush from the Carnegie Endowment.
Sorry, yeah. Naive question, perhaps. So my daughter just took out a mortgage. A mortgage broker said that she could get 4 to 5 times her income, 3.5%, 30-year rate. Why can my daughter borrow 4 to 5 times her income, but the United States government cannot? I just want.
I think that may be a Jose
I'm asking you
Vinal's
this
question rather
partly
than a
because
Carlo
I'm very
Cottarelli.
worried about my daughter. But the other question, just very quickly, why do you say nothing about the size of government in your presentation? So you have China that has a government spending receipts, 24% of GDP, and France that has 57% of GDP. Does that not matter in the fiscal monitor?
Okay, on And your daughter, as you said, maybe your daughter should not borrow that. Look, the honest answer is that we don't really, it's a matter of uncertainty. We don't really know what is the level of public debt that could be sustained, simply because we have very few examples, cases of public debt of this order of magnitude, 100% of GDP, 120% plus. We have seen, definitely, we have seen some countries that did get in trouble at these levels. The US obviously has a lot of much more credibility. The question is that once you have been in a territory where you have rarely been, then it's time to reason that you want to move cautiously. We don't really know. So some degree of caution is simply appropriate because it's uncharted territory. Of course, the US had a debt to GDP ratio that was higher than the current level in the Second World War, but the world was very different. As I said, I listed the number of differences there are. So simply principle of management under uncertainty would suggest that you want to be cautious about the limit that could be acceptable for any country. On the size of government, no, I did not discuss this issue today, but we have discussed this issue in the context of the measures the various countries should take to implement fiscal adjustment. And we have argued that it's inevitable that countries with a large government where taxation is already high and public spending is already high should move more on the spending side, should reduce the size of government. Countries that instead have lower tax revenues to GDP ratios like Japan or the United States, we think that there is an adjustment that needs to take place also on the revenue side, particularly taking into account the magnitude of the fiscal adjustment. It's unlikely that it would be possible to do it only on the spending side. So we have recommended measures also on the revenue side for these countries.
Great. At the rear mic.
Thank you, Thomas Hillebrand from the Institute here. You mentioned the DeLong and Summers paper, and it seems like you were generally accepting their results. But if I understand their paper correctly, they actually find that the cost-benefit analysis in terms of current and future growth might be negative even if countries manage to reduce their debt-to-GDP ratio. And moreover, the impact on the fiscal burden of financing that debt might be negative because the reduction in government revenue might more than offset the reduced interest payments. So I was wondering whether you've done any simulations looking at the impact on growth now and in the long term and on the financing burden. Thanks.
Yeah, I mean, I would not take at face value all the results in the long Summers paper. There is one issue that we have actually explored about what exactly they do in terms, because essentially they compute the increase in future, they compute the future tightening based on what would be necessary to service an increased amount of debt. They don't compute the fiscal tightening that would be necessary, however, to bring down public debt to where it was. Because in principle, if you want to be completely neutral, you not only need to service the additional amount of debt, you need to go back to the original debt position. They don't do this. So again, on the specific argument, I would not take everything at face value. I would simply note that at least some believe that there is also this point, which intuitively has some appeal. On whether the specific calculations are right or wrong, one can take different views.
Thank you. Bill and then Joe.
I think this is excellent work in general.
This is Bill Klein from the Peterson Institute.
The Institute. I think, though, my concern is illustrated by the fact that on your key graph, the U.S. was unambiguously closer to default and all of those terrible things than is Spain. It was toward the northeast on your chart, unambiguously. And I think this raises a general problem. In fact, when we had Moody's in here, they said that they take into account the cost of the debt. And they actually made the statement that historically you've got this awkward problem that there's a lower interest rate for the countries that have got the highest sovereign debt. So it seems to me that you've got some need to take account of the differences. An obvious difference is if you've got the debt in your own currency, then you're not in the same situation being unable to print to pay it off. I think for the U.S. in particular, and more generally, you've got a problem between the gross and the net concepts. Japan, 250% gross, 135% net. If there's any meaning at all of those assets, surely it's the net that you should look at. And more, in the case of the United States, you have the debt held by the public, which is quite different from the gross debt general, and it's very pragmatic with the application. Debt held by the public, if we don't roll back the sequester, will be about 73% of GDP by 2020, if I've got the numbers right. It goes up a bit, then it starts coming, it stabilizes. Many would say that if you can get it there and ease it back a little bit, that's not too bad. But you want to go implicitly from a current 105% gross general government debt ratio to 60%. Well, that's a 40% of GDP rollback, which is a massive primary surplus sustained in excess of the interest rate and growth rate, or minus the growth rate, for a long period of time. So, in sum, I worry that your methodology, which is sort of necessary if you're going to do all this cross-country stuff, doesn't get you into trouble with countries that have a revealed very low sovereign risk spread, the CDS. So, and you also get into the problem, if you look at your chart historically how all these countries are terrible, if you did that by the ratio of their interest payments, their net interest payments to GDP, it would look very different because of such low interest rates. Anyway, all of which is to say that I think one has to be a little careful about applying all of this.
Yeah, no, I mean, I agree. I mean, let me, however, there are several things that you mentioned. Some of them are more relevant than others. A couple of things that are perhaps less relevant. I don't think that the difference between net and gross debt makes a huge difference. In the sense, we'll be running the scenarios with net debt too. Obviously, at that point, the threshold will not be 60%, will be the corresponding threshold for net debt. 60% was the median gross debt to GDP ratio for advanced economies in 2007. If one use net debt, one would have to take a lower number. So I don't think, and for some countries, however, where there is a very large difference between gross and net, like Japan, we do use the net figures. The other point that is much more, that you made, however, is much more important. When we make those calculations, in a way, we look at the deficit and debt numbers, and from these you have those charts that are computed. Where, however, the interest rate that a country pays on its debt comes into play is where we assess the proper pace of the adjustment or not. There are some, as I said, countries where they pay very high interest rate, they need to adjust more rapidly. Countries that pay a very low interest rate, they can adjust maybe in 50 years rather than in 20 years. The scenario that we show are illustrative, clearly. And so we don't take 60% as a firm target. Indeed, in our, you remember, each country is represented by a set of dots. In some cases, we take 80%. The question, however, is to what extent, and this goes a bit in the opposite direction of the one I was saying, to what extent these very favorable conditions will last in the long run. At the moment, the interest rate growth differential for the US is very negative. Before the crisis, in the 20 years before the crisis, the interest rate growth differential for the US was on the order of 0.7, was positive and well above where it is now. In our long-term scenario, we project it will increase gradually. It will remain negative, I believe, until 2018 or 19, but then it becomes positive. By how much? One could say, well, it will go back to the historical average, 0.7. Others, however, could argue, well, but public debt is much larger, so it will be above the historical average. So this is a very big margin of uncertainty, and clearly, so our projection need to be taken with a grain of salt. It still remains true that hoping that this very negative interest rates to growth differential will remain in the long run, I think is too optimistic in light of the historical record. So what happened before 2007?
No, it's a really good point, Carlo, but you didn't address something that Bill raised, and that I don't want to preempt Joe's question, but that a number of us raised, which the IMF seems to never explicitly address, which is, if we look at your chart with the bubbles in the upper right corner, and you say it's necessary, not sufficient, to be in that corner, to have bad debt, but the big bubbles are all countries that don't control their currency, and the little bubbles are all countries that do control their currency. So I understand we don't want to offend our friends from the euro area, that's fine, but as an analytical matter, does the IMF have an opinion on the fact that you seem to have more room to run if you have your own currency?
I think the answer is definitely yes. There are, however, a couple of caveats couple of qualification that I would add. One is that, again, may not be the case of the US, but you have seen several countries that were able to print money, and yet they got in trouble from the fiscal accounts. And one case in point is Turkey in the 1990s, with high deficits, printing money. Perhaps the default risk was very low, but the exchange rate risk was very high. And real interest rates were very high. Again, not the case, not comparable to the US, but analytically there is also this point that needs to be taken into account. Second point, and this is more blurred, but I think it's not trivial. We don't want to overestimate the power of central banks. We thought before 2007 that, well, if there was a problem in the financial sector, the central bank would just intervene, print money. When there are large imbalances, you don't really know whether, for one reason or another, the central bank will be in a position to solve the problem. We don't know why what may prevent the action of the central bank. It may be that there is, at the same time, an oil shock, and therefore inflation is spiking. It may be that for some irrational reason, perhaps people start being worried about fiscal dominance. But maybe there may be something that will prevent at one point the behavior of central bank. So again, it's a very uncertain, uncharted territory. You don't want to take a extreme position. You need to move cautious. But analytically, yes, if you have your central bank, it's much easier.
Okay, no, thank you for clarifying that. Joe, did you have something else?
Well, thank you, Joe Gagnon of the Peterson Institute. Adam, actually, that was the core of my question, but then you give me a chance at least to follow up, which is, I noted, by the way, on that chart of the CDS spreads and the debt and deficits, that all of the CDS spreads that were high are in the euro area, all of them. And it really does explain the puzzle that you mentioned. But I would add on Turkey, I mean, it's not just do you control your own currency, it's also, and are you exposed to risks from using that power? So, for example, in the Turkey case, the government and private sector in Turkey had borrowed a lot in foreign currencies, and using their independence to print money would have raised the debt burden enormously and caused bankruptcy problems. So it would have made it hard for them to use that independence in a way that the US and many other countries don't have that risk. So I would submit to you that I would challenge you, in fact, to come up with a debt crisis, a black swan event in a country like the United States. I cannot think of one. And I think, if anything, it's going the other way. Again, I would challenge you to, it seems to me we now have tools for monetary policy that we didn't know we had and we never used, in terms of guidance on future interest rates and purchases of long-term bonds. So it seems to me, although we know interest rates will have to rise to keep inflation on track, there's no reason that a central bank anymore should allow a black swan. At least not if it has control of its own currency and doesn't have borrowing in foreign currency. And then my question to you would be, to what extent should the ECB be trying to tailor its powers towards its individual members as opposed to standing back and letting the markets control interest rates in the periphery?
That last question, by the way, you may choose not to answer. You are, of course, head of the fiscal department.
Again, on the black swan thing, first of all, we have to understand what we talk about. For the US, for some countries, we talk about open fiscal crisis, and even that is even less likely. But when we talk about increases in interest rates, that will still be damaging for the economy, and it will still be related to sort of risk premium or high, related to the high deficit and high debt. Well, that is possible. We do find events like this in the past for advanced economies. Maybe not fully blown crisis, but and if we don't see them, sometimes it's because country authorities intervene ahead of these events. Canada in the 1990s. A big story there for the prompt of the fiscal adjustment was exactly the fear that interest rates will start spiking. So I think that one is to be cautious in excluding events that are unpleasant, maybe not a full fiscal crisis, but increasing interest rates, again, it's possible it will still be damaging for the economy. And then there are also some who would argue, we have black swans by definition have not been observed before, so you have to be cautious. And the second answer, I will follow the suggestion.
Very good. I think we've almost run the gamut. Does anyone else care to pose a question or comment to Carlo, who's been remarkably comprehensive and forthcoming? All right, then. Well, again, thank you so much, Carlo. That was terrific.
Thank you for the invitation.
We're all going to be continuing to watch the fiscal monitor, but also all the good work your department is doing.
Thank you very
all
much.
very much.
Thank you.